I'd like to welcome former Dallas Fed president and 36-year tenure with the Federal Reserve System, Robert McTeer. Bob, thanks for taking the time this Fed Morning Wednesday.
My pleasure, Rick.
Listen, I know that we could do a lot of debating about should or shouldn't the Fed normalize policy. But before we get to that, it certainly seems though the recent spat of data has slowed. There is now talk that the first quarter numbers, when we ultimately get them in about a month and a half, may be close to zero. Is any of that going to have an impact on today's decision as to the wording of the statement or the eventual normalization of rates?
It may very well. We have had a weak industrial production, retail sales, housing starts. If they're data dependent, these latest statistics are going to push it forward. However, Rick, given the way the markets are reacting to news, I think they ought to go ahead and do it. It's not going to be a big deal.
All right, and okay, now that's a great place because I happen to agree with you. So there's really two discussions. If we just look at the recent trends and think data dependent, maybe we can come to a conclusion to postpone again. But if we consider that we're at zero interest rate policy, that we probably should be closer to 1.25, 1.5 missed opportunities in 2011, 2012 to tighten. Normalization here might go against the grain of logic because rates are too low. Now, having said that, do you think the word patience comes out but gets substituted for something that keeps us on a data-dependent track and certainly won't clinch the notion of a tightening anytime soon?
I think they will mess around with the word patience. They won't just remove it and leave a hole, but I think they need to to weaken that word, and they probably will some way. What convinced me, Rick, is the February employment report. It was so good. And yet the stock market Dow went down 300 points. If we're going to react badly to good news, I'm for just saying go ahead and let her rip.
I got you. Now let's look at the risks. To me, I take that Band-Aid off. There's two areas that I think we need to pay close attention to. One is leverage credit, the status of how mutual funds and how many hedgies try to get good returns at a time where rates are low because they leverage. They own high-yield corporates. And then the other issue is about the value of stocks. If stocks go down, rates are going to go down, period. But what do you think about the leverage credit markets? In my opinion, that's where the risk is near term should the Fed get aggressive or normalize.
Well, yes, rising interest rates are going to put downward pressure on those instruments. It might not be pretty. But they could go for a quarter point, Rick, and that would be a slight tightening. And who's afraid of a quarter point after 6 years of zero?
No, I'm totally with you. And we have another minute here. Getting back to the stock side, a lot of people on the floor here have good memories about the taper tantrum. But as I look at the January trade in stocks and fixed income this year and last year, I still come to the big conclusion that it's all about stocks with the Fed. Because if the Fed decides to normalize and stocks go down, they don't need to worry about Treasury rates. They're not going to go up with stocks going down. In the final 30 seconds, comment on that logic.
Well, I think that's probably right. I don't think the Fed started out thinking that the stock market was what they were trying to manipulate, but I think it ended up being that, and the stock market is sort of the referendum in this country of what the Fed's doing. So they're going to be very reluctant to do major damage to the stock market.
Bob, it's always a pleasure. I guess I'm glad I'm not in Janet Yellen's shoes right now. Have a good day, and maybe we'll talk after we see what happens at the press conference.